Joining me is Michael Schumacher. He's head of macro strategy at Wells Fargo. Michael, it's great to have you back. And I mean, listen, the core CPI up 0.6 on the month. Those aren't the kind of readings we want to see.
No, it's a pretty grim number, Kelly, and frankly, it's broad-based, and that's really the huge problem for the Fed. Whether you look at food, energy, or in the core, services up 0.7%. The Fed has talked about this really being a goods inflation for a while, supply chain, but it's not just that, it's much more. So broad-based, really challenging for the Fed right now.
And what tells you that this is broad-based in response to those who go, nah, it was just airfares, airfares jumped, that's the whole story?
Yeah, it's funny. We've heard a number of these stories. So this month, airfares, previous month, used cars. But it seems that the bad actor changes month by month. And if you look at the breakdown, most categories are up quite a bit. So again, whether it's services, whether it's food, energy, airfares, you named, any number of things, it seems like they're all pointing in one direction, up. And I think the big takeaway, too, goes back to some of the comments from the Fed meeting last week. You've got to focus on the labor market. The labor market's incredibly tight. That tends to embed these inflation expectations, which drives prices up across the board. So super tough time for the Fed and really globally for policymakers.
It's not that you're quibbling with what the market thinks the Fed will do this year. It's now 2023. We're almost halfway through, so it's time to start talking about what's on the horizon. And you think there's going to have to be a lot more tightening next year.
Yeah, it's interesting, Kelly. So we've got record high inflation, at least in the last 30 to 40 years. We're talking about it being good news that it's only 8.3% over the last year. And the market's saying, hey, wait a minute, we think the Fed's got this. It'll be mostly done this year, only maybe 2 interest rate hikes next year. That seems really far-fetched. We don't buy it.
So let me follow up on that. I mentioned off the top, there's a level at which you'd be more interested in sort of buying treasury bonds or bonds broadly speaking, but we're not here yet. So basically, you say you want to see the market pricing in closer to a 4% Fed funds rate than 3% as the end point for Fed rate hikes. Is that right? And once they price that in, then you'd feel more comfortable?
That's definitely right, Kelly. So from our perspective, and just to give the viewers some context, the market currently is pricing maybe 320, 325 for the end of the cycle, something like that, to be reached in the middle of 23. We think that's way too low. Got to tack on an extra 50 basis points at least, so 375, maybe more. At that point, we'd be comfortable saying, hey, bonds have really taken it on the chin. Perhaps it's time to get in. But until the market really prices that sort of level out of the Fed, we think there's just not enough cushion built in, not enough protection against inflation, so I would steer clear. So, yeah, the level is sort of in sight, but not there just yet.
Well, that is the perfect segue to what we just heard was a pretty poor 10-year auction. Michael, we'll leave it there. Thank you so much for your time.
Thank you, Kelly.
Michael Schumacher with Wells Fargo.